In 2023, there's one country which could make a global recession much worse: Japan.
Japan's the third largest economy, and it's an important economy because its financial sector is intertwined with the financial sector of the rest of the world.
Japan is the world's biggest creditor country. It holds trillions of dollars of assets overseas, which means what happens here has the potential to affect the world's financial markets. In recent years, Japan's central bank, the Bank of Japan, has been reassuringly predictable, keeping interest rates low thanks to its very low inflation.
Interest rates only have to go up when inflation rises, and that just hasn't happened. So for a long time, Japan defied any predictions that it would have to raise interest rates or tighten monetary policy, to the extent that betting that it would have to do that was a notorious way to lose money. It was a trade called the widowmaker. It was always wrong.
Even in the face of the pandemic and the energy crisis, the Bank of Japan held fast.
The Bank of Japan, increasingly an outlier,
keeping its overnight interest rate at minus 0.1%.
The dovish tone continues.
Oh boy, does it ever.
That is until now. As interest rates have risen elsewhere in the world, Japan has found itself exposed by the widening gap.
The effect of that has been to make the Japanese currency, the yen, less attractive to international investors, because if you buy the yen and invest in the Japanese bond market, you're getting a lower interest rate, lower return than if you invest in the US Treasury market, say, where you can benefit from those higher interest rates.
As a result, the yen has fallen against the dollar, making imports more expensive for Japan, which pushed up the rate of inflation. So at the end of 2022, the Bank of Japan did something unexpected. It was all to do with the interest rate, known as the yield, on one particular form of Japanese government debt, its 10-year bond. The yield on this bond is crucial in Japan because it affects a lot of economic activity.
Often, borrowing by companies, mortgages, and all kinds of contracts are related to long-term interest rates. So the idea is by keeping those interest rates low, you stimulate spending and growth in the economy.
The Japanese central bank has certainly done that by capping the yield of its 10-year bonds at 0.25%. The yield of a long-term bond moves in the opposite direction to its price. So in order to keep the cap in place, the Bank of Japan has been buying as many bonds as necessary. But in December 2022, the Bank of Japan increased the cap to 0.5%. It might seem a relatively small move, but it was enough to destabilize the markets.
Global markets were jolted overnight after the Bank of Japan unexpectedly widened its cap on 10-year Japanese government bond yields.
And it was also an indication that in 2023, the Bank of Japan might go even further. The question is, how much further? It could ditch the cap completely, but it could also start to increase short-term interest rates too, as other central banks have done already.
What's happened in 2022 is that central banks around the world, and most importantly America's Federal Reserve, have been raising interest rates. And what that's meant is that there's been a growing gap between interest rates in Japan and in the rest of the world.
The Federal Reserve, for example, has increased interest rates from 0.25% at the start of 2022 to 4.5% at the end. But if interest rates in Japan climb the same distance in 2023, it would be much more concerning, because Japan has the highest level of public debt of any rich country. While interest rates were low, high public debt was manageable. But if interest rates rise, investors will start to worry that Japan might not be able to service its debt and start to sell their bonds, causing bond yields to go up.
Suddenly it's going to be more expensive for companies and for individuals to borrow. If there's a dramatic repricing in rates, that can be quite destabilizing for the economy.
And because Japan is so intertwined with the rest of the world, this destabilization could spread to other financial markets, which means what the Bank of Japan chooses to do in 2023 could make any global recession much worse.